Good morning, ladies and gentlemen. It's a great pleasure to be with you again today. So my aim today is, as it always is, and that is to give everybody a quick update on South Africa's economic performance and hopefully some indication of what to expect in the years ahead. So let's get going with that. Before we delve into the macroeconomic landscape that is likely to dominate not only for the rest of this year but for the years ahead, let's have a quick look at how agriculture itself has performed. Now, the good thing is that for everybody in agriculture, you've not been as badly affected by the shock of COVID-19, by the pandemic, and by the horrendous Level 5 lockdown, which basically resulted in the economy grinding to a halt in the second quarter of last year. As for agriculture, life continued pretty much as per normal. And we have seen that during the course of last year, as this graph will clearly show, agriculture has actually been the top performer in this economy. And maintained that level pretty much coming into 2021. So really provided a nice and solid boost to economic growth during the course of 2020. A little bit slower going in the first half of this year, but nonetheless very robust. And so among all the industries out there, we have certainly seen that agriculture has been one of the top performers. So now, given this context where you've had a fairly robust 2 years behind you, the question is, where do we go from here? What happens to the economy going forward? And the good news is that a recovery of sorts have started, all right? So we are in a situation where the South African economy has started to climb. It's a very steep climb, but has started to climb out of the lockdown-induced pit. And as a result, our GDP growth rate has improved, but although it's still very negative. So what we've seen is that the rate of contraction in GDP has slowed from a frightening 17.8% in the second quarter of last year to a more, well, still scary, but more acceptable 3.2% contraction in the first quarter of this year. Where did the growth come from in the first quarter of this year? Well, it essentially came from three main sources. The first being, of course, government. Government really, COVID-19 wreaked havoc with government's finances. We saw that tax revenue imploded, but at the same time, government had a responsibility to offset the contraction in the rest of the economy, to shield the economy as much as it could against what was undoubtedly going to be one of the worst recessions we've experienced since the Second World War. And so what government did is they leaned against the tide, they leaned against the wind, and they kept their spending constant. Although they didn't grow it, they kept it constant. And you can see that's that beige line there. But the real lift, the real recovery only started once the private sector had some room to maneuver, once Level 5 lockdown was lifted and restrictions started to ease. And what we saw then was that the boost really came from exports, a very nice recovery in exports. That's that red line there. And from consumer spending. Consumer spending also rebounded quite sharply and quite quickly once Level 5 lockdown was lifted. So that's where the growth came from in the first half of the year. What we're going to ask ourselves now is, where's the growth going to come from in the years ahead? Right? What we can basically, what we know is there are only a few sources of demand in any given economy. Firstly, of course, government is a source of demand. Government can be a source of demand when it undertakes consumer spending. It can also be a source of demand when it undertakes capital expenditure, which is the good type of spending. This is when you build power stations and when you build roads and schools, put in place decent public transport systems. That is capital expenditure. So government can be a source of demand through either one of those two channels. Then, of course, companies, a very important source of demand. Where we measure their contribution is essentially through capital expenditure, because otherwise there's a whole bunch of double counting. So we mainly capture the contribution of companies when they expand their operations and undertake capital projects in order to boost their production in the years ahead. So that's one source of demand. And then the final one, second final one is, of course, consumer spending. That's a big portion. It makes up the lion's share of GDP in almost all economies. And then lastly, there's also the rest of the world. That's a source of demand that can help our economy grow through, of course, exports. Right, so let's first start and let's see how each of these sources of demand are likely to play out in the years ahead. Just because it's easier, I'm going to start with those factors that I do not think will drive growth in the years ahead. The first one is government. Government's ability to support this economy has been greatly reduced by over a decade of corruption, of the hollowing out of key institutions, of state-owned enterprises, by really a lack of capacity itself, both in the forms of management capacity, skills. They don't have the necessary skills really to drive growth in any significant way. And then, of course, after the pandemic, after the strict lockdown of the second quarter of last year, government now sits with a massive budget deficit. In 2020, 2021, and that particular fiscal year, which ended in March this year, it is estimated that the budget deficit will be over 10% of GDP. So, that is way above what is considered a sustainable level, which is only 3% of GDP. So we're miles away from what is a comfortable and sustainable place to operate. And because the deficit, just exploded during the course of last year, government had to borrow a lot more. And now they sit with a public debt burden of over 80% of GDP. If you add the debt of state-owned enterprises such as Eskom, Transnet, Armscor, and so forth, and so forth, you wind up with debt of over 100% of GDP. So they're sitting with large budget deficits, a mountain of debt, and really their ability to provide any further support to this economy is very, very limited. They can do us a great favor if over the next decade they focused really on getting their own act together, on reducing the budget deficit, at slowing the rate of increase in public debt, and ultimately start to bring it down to a more sustainable level. And the reality is, although government can raise taxes, there's a limit to which that remains effective. And we are pretty much on the precipice of that already. So increasing taxes even further can often be counterproductive because it just causes your economy to contract. And while you might get more tax revenue from some sources, you get less tax revenue from other sources as the economy slows. So how much you can do with higher taxes? Very limited. So the only option for government really going forward in order to reduce this massive, frightening budget deficit and to control the debt burden is essentially to cut spending. And if they're cutting spending, it means they're putting less demand in the system. And in fact, government is not in a position to boost growth. That much is very clear. They're going to be a drag on this economy, not just for the rest of this year, not just for next year, but for the next decade in all likelihood, because that's how long it will take for them to get their spending down and to fix the deficit and debt problem. Another source of demand, which is not going to support us in a hurry, is fixed investment. And this is unfortunate because, as you all know, fixed investment is the good type of spending. That is when companies go out there, take the risk, expand their operations, build a new factory, put up a new branch, build another shopping center, build more residential buildings and so forth. And what the outcome of that, of course, is there's a whole chain of events that support the economy, from the construction all the way through to the point where you have actually completed your capital project and you've put the additional productive capacity in place. And during that process, of course, it supports employment. In fact, the recovery in fixed investment is the key to really kickstarting a faster and a more rapid pace of job creation in South Africa. But unfortunately, fixed investment has been exceptionally hard hit by strict lockdown last year, and the recovery has been almost non-existent. In fact, you need a magnifying glass to find it on this graph. But what you will notice is that there was a little bit of a bounce in the second half of last year, and by the time we came to the first quarter of this year, basically ran out of steam completely. And especially private sector fixed investment relapsed, contracting by 8.9% again in the first quarter of this year. So what's the problem here? The problem here is that the decline has been caused by a very sharp contraction in fixed investment by state-owned enterprises. In fact, in a collapse in capital outlays by state-owned enterprises. Now, why does that matter? Well, in South Africa, we have opted for a situation where state-owned enterprises essentially provide all our economic infrastructure. Let's think about it. Electricity, road, rail, port infrastructure, all provided by state-owned enterprises. They even dabble in things like telecommunications and other communication systems and networks. In other words, if they are, as they are, in poor financial position, sit with very weak balance sheets and very little cash flow, and also no capacity to really undertake capital projects, essentially they are constrained on all other forms of capital expenditure. The private sector cannot expand their operations without access to electricity. So the reality is the collapse in capital expenditure by state-owned enterprises have dragged down capital expenditure in the overall economy. It's made it very difficult for private companies to expand their operations, either very difficult or very expensive. Now, there's been some positive developments on this front. The most positive development is that government recently allowed and made a concession to allow 100 megawatts of embedded generation, thereby giving companies the ability to put in their own electricity generation capacity. Now, obviously, this is not going to happen overnight. It's still a cost to the private company. They still have to undertake that expense. In other words, they must still believe that demand is going to be robust enough to justify that. But nonetheless, it is a way around South Africa's acute electricity shortage. We don't think that it's going to change the picture for capital expenditure this year. Probably not even next year. Maybe towards the end of next year and into 2023, we will start to see some activity on that front. We will start seeing companies take up that concession, start to use it more aggressively, and if they can put in their own power supply, they are in a position where they can expand their operations. But the bottom line is we're in a bind at the moment where fixed investment's probably going to remain weak for the rest of this year and only start to recover very, very slowly from next year onwards, and not nearly fast enough to get those sorts of virtuous cycle going and to get some job creation growing, which South Africa, of course, desperately needs. So fixed investment's not going to drive this economy going forward. Government spending's not going to drive this economy going forward. So where's it going to come from? Well, we're going to have to rely on exports and consumer spending to do the heavy lifting. So what are the chances that they will continue to do so? It is really exports and it is consumer spending that got South Africa out of that deep pit we fell into in the second quarter of last year. So can we rely on them to continue to grow and to continue to provide at least some base demand in the system and keep the wheels on the bus turning while we try and repair some of the damage that have been done elsewhere in the economy? The good news is exports have remained exceptionally robust, not only in the first quarter of this year, but also in the second quarter of this year. And exports have literally pulled away from imports. And so as a result, South Africa is a net earner of foreign exchange at the moment, and we are sitting with, for the first time in a long period of time, a trade surplus of almost 8% of GDP. This has translated into a current account surplus of almost 4% of GDP. So a very impressive situation we find ourselves on that front, as exports have rebounded very rapidly. Now, will it continue? Well, the key factor driving exports going forward is, of course, the global recovery. What we've seen is a very nice and robust rebound in global economic activity. Now, the world economy at large took an enormous hit in the second quarter of last year. The IMF estimates that there was one point in the second quarter of last year where essentially 85% of the world economy, I mean, it's absolutely unbelievable, 85% of the world economy was under strict lockdown and, in fact, shut down. But from that point, as we entered the third quarter of last year, throughout the fourth quarter into the first half of this year, we have seen a fairly impressive rebound. And that rebound has occurred really across the globe. All countries have fared better in the second half of last year and the first half of this year than they did in the first half of 2020. So there's been a nice, strong little rebound developing in the world economy. Now, what's brought that about? Well, firstly, the world has gotten smarter in dealing with COVID itself. So when the pandemic initially hit, no governments really had a script as to how do you deal with such a crisis. And so they undertook very extreme measures, and they basically imposed strict lockdowns and quarantines, and that just brought the economy to its knees and caused a tremendous amount of damage. Now the virus is still with us. It's still circulating around the world, and it's mutating as we're going along and developing more deadly variants. Yet we are handling it better. So governments have now learned to target those industries where there is a high level of human contact. That unfortunately means that some industries have really been scarred very badly, and will probably remain under pressure until the world at large have defeated COVID. But other industries have bounced back very strongly. So restrictions, COVID-19 restrictions, have become better targeted to those areas where you get the maximum health outcome without completely slaughtering the economy. So that's the good news. So that's one factor that contributed. The other factor is, of course, that we've seen the virtues of technology, and what that has enabled businesses to do is to continue to operate even though they can't be in the office or in the factory. And so that adaptability of businesses have also made it possible for us to recover from hard lockdown last year. And then finally, and very importantly, and probably the most important element or facilitator of the recovery we're seeing across the globe, is the development of a variety of effective vaccines. Now, in your advanced countries, they have rolled out these vaccines very rapidly, which has meant that in many advanced countries, they've essentially been able to lift almost all restrictions on economic activity. And what we've seen, therefore, is a very strong and robust rebound in many of your advanced countries. Then, on top of that, throughout this crisis, global monetary policy has been extraordinarily stimulatory. We saw your advanced countries, including the US Federal Reserve, slash interest rates to near zero. At the same time, they opened up the tap on the printing presses, and they injected truckloads of liquidity into the system, and they kept the credit rolling. And it didn't end there, because fiscal policy played a very important role in mitigating the damage from this particular pandemic. Governments, especially your rich countries, really undertook very aggressive fiscal stimulus and support and emergency measures, providing direct financial support to both households and companies to help carry them through the lockdown. And that has been very, very instrumental. Nowhere has fiscal policy been more aggressive than in the United States. When President Biden took over the US administration in the early part of this year, he quickly went about to put in place a $1.9 trillion stimulus package, which followed on several stimulus packages during the course of 2020. That took the US fiscal stimulus to over 10% of GDP. It's just unprecedented. It has never been done before, not even during the Great Depression. And as a result, they sent checks directly to households, and that boosted confidence, and that got their economy going again. So with this cocktail of monetary and fiscal stimulation, plus the easing of restrictions, the rapid rollout of vaccines, we have seen a fairly convincing global recovery take hold. So much so that the IMF now believes the world economy will grow at 6% this year, which is exceptionally robust, and it is in fact growing by more this year than it shrunk last year. So that includes about 2% of actual growth. And they expect that momentum to continue into 2022, where they're looking for 4% growth. In global terms, that's very strong. And then they ultimately expect the global economy to return to trend growth of around 3%, which is still in global terms an upswing. So they're expecting fairly robust growth to come from the world economy. The momentum is probably going to come from the US and China this year and also even next year. So among your emerging markets, it is China providing the oomph. Among your advanced countries, it is undoubtedly the US providing oomph. The US is anticipated to grow by 7% this year. It's a sort of growth rate they have not seen in a very long period. Now, this combination of a rapid rebound in economic activity as lockdowns have been eased and vaccines have been rolled out, and this enormous stimulus, particularly the fiscal stimulus, have supported demand for commodities the world over. And so what we've seen is a very, very strong rally in commodity prices. Now, a lot of people are saying it's overshot a little bit. We should see commodity prices start to moderate a little bit towards the end of this year. But everybody is also kind of starting to anticipate that we might go into a period of 5 to 10 years of elevated commodity prices. Why? Because of the nature of the fiscal stimulus, particularly coming from the US, also from the Eurozone, from the UK, from Japan. There is this new emphasis on rebuilding infrastructure. Now, if you're building infrastructure, you need iron and steel, you need aluminium, you need ferro manganese, you need chrome. And we, as South Africans, sit with large deposits of all of those commodities. And so that will support demand for South Africa's export, particularly our commodity exports. There's another element to this fixed investment that is being undertaken by the US and other advanced countries. And that is they want to accelerate the transition towards green, sustainable energy and transport networks. Now that's going to require massive investment over the next decade. And of course, the aim here is to mitigate the damage of climate change. And unfortunately, we're starting a little bit late with that because the climate's already changing. We are already seeing extreme weather events causing enormous risk and damage the world over, and also affecting the livelihoods of people the world over. But nonetheless, there is now an emphasis on it, and that will require huge investment. And here's the thing about renewable technology, whether it's for transport networks or whether it's for electricity. Renewable technology uses 30 to 40% more commodities than your fossil fuel alternatives. And that means there's going to be huge demand for things like lithium and cobalt and your phosphates and all of those types of commodities. Now, while South Africa, and particularly copper, of course, let us not forget copper, because if you want to electrify everything, you need copper. But the reality is South Africa doesn't have large deposits of some of these type of commodities that will be used in renewable technology, but Africa does. And South Africa, to a large extent, is a gateway to Africa. So there is an opportunity for us as well. So the exports of both goods and services should remain strong in this global environment. And we should see continued support for South Africa's overall economy from robust economic growth globally and also from increased fixed investment in advanced countries, and as a result of that, from a very positive terms in trade, where our export prices exceed our import prices. What about consumer spending? Can it do some of the heavy lifting? Well, it did not decline by quite as much as many other industries did and many other sources of demand did during the lockdown, and it also bounced back very quickly, all right? But the reality is the consumer is a bit of a mystery at the moment. What we have seen is that consumer spending has been sustained not only in the first quarter, but also in the second quarter of this year. We have seen, as we went from level 2 lockdown to level 3 lockdown in January, that consumer spending was hit a little bit, but it bounced back very strongly in February, March, April, and May. And you're probably going to see that same effect. Every time we go through another wave of COVID-19 infections, every time we have a little bit of a stricter lockdown, consumer spending will take a bit of a dip. But what we're also seeing is its ability to rebound is quite significant. So, what about the consumer? Can it continue to do its magic? Well, it depends on the financial condition of consumers, right? Which is a function of what? It's a function of employment, it's a function of wage increases, and it is a function, of course, of confidence in general. And finally, it is a function of the cost of credit. In other words, interest rates. So let's first deal with income. Right? So there are two elements to income: job creation and wage growth. The interesting thing, as you can see in this graph, is that personal disposable income have returned to pre-pandemic levels in the first quarter of this year. But it's a bit of a mystery, because it appears like all of the heavy lifting has been done by compensation of employees. Yet we know that wage settlements or wage increases have been a lot lower at the early part of this year than it had been compared to pre-pandemic levels. Yet compensation of employees have recovered to pre-pandemic levels. So what could be behind this? We think other sources of income, things like profits, rents. As you ease lockdown restrictions, these bounce back quite convincingly. We also think that because you've had a situation where as you've eased lockdown, people have started working more normal hours, and therefore their income has normalized as a result. But what is very clear is that it's not coming from excessive wage increases, because these have been generally below the rate of inflation or exactly in line with the rate of inflation. So wage growth has not been spectacular, not in the private sector and not in the public sector. And confidence remains extremely weak. Okay? And the reason confidence is so weak is because employment has not really moved or recovered nearly as fast as the rest of the economy has. So that's why that income of households are a bit of a mystery, because you can see in this graph that although employment has rebounded from the depths of lockdown and is at a higher level, we've seen some employment growth in the second half of last year, not in the first quarter of this year. In fact, we had net job losses in the first quarter of this year. We are still miles away from the pre-pandemic levels of employment. So employment has not done the heavy lifting. Wage growth has not done the heavy lifting. So almost all of it has come from other sources of income, profits, rents recovering as lockdown has been eased, and also the normalization of working hours, which allowed people to earn a more normalized income. So on the income front, we think you'll continue to see employment edge higher. It's going to be a very slow and long climb back to pre-pandemic levels. Obviously, that will support household income. Wage growth is, in my opinion, going to be quite subdued, not just this year, but next year and probably even into 2023. And then it should start to recover more significantly. The reason I say that is because the focus of companies at this point is to restore profitability and to strengthen their balance sheets. Now, the only way they can restore profitability when demand is fairly subdued, in other words, their sales volumes isn't racing ahead, is by controlling cost. And wages is a big element of those costs. So the prospects for wage growth is quite muted until we get to about 2023. So what is going to carry the consumer forward? You will see disposable income grow, but it's going to grow very slowly. It's not going to provide momentum to consumer spending. Well, what I think you are going to see is that consumers have become very cautious and they've become very responsible in their finances. And during the course of last year, South African consumers became net savers. That's what this graph shows you. So here's the thing. They've got this stash of savings that they've put away. Right? And so once confidence returns, some of that saving will be redirected towards spending. Not all of it, but some of it will be redirected towards spending. And so that presents some upside to consumer spending. The other thing we've seen is that household wealth levels have actually bounced back, and consumers have been very responsible in their borrowing. Debt has slowly crept up, but it's nowhere near the peaks we saw during the global financial crisis. And while debt has slowly crept up, so households are borrowing a little bit more, but they're very cautious, debt service costs have dropped to multiple decade lows, all right? And why is that? Because the Reserve Bank has cut interest rates. And so this is what I think happened to the consumer. There are a group of people in South Africa, your middle class and upper, which generally consist of skilled to professional labor, and their jobs were not at risk by the pandemic. Their jobs were not threatened by lockdown. But what lockdown actually did for them is it lowered their their operating expenses dramatically, freeing up disposable income. All right. At the same time, this is also the demographic that tends to borrow money from banks, right, to buy a property, to buy a car. And as interest rates came down, that freed up disposable income. And so this group actually benefit. They had much lower expenses, they didn't pay that much on servicing their debt, and they sat with this windfall of cash. And they did the following with it. They spent a little bit more on discretionary type items like building a home office, a new computer, a new printer, but a big portion of it they saved, just in case things got worse. And once confidence returned, you should see that spending being diverted back. That savings being diverted back to spending. The other thing, of course, we've got is that household wealth is in a very good shape. This relates to the rebound in equity prices from the lows of last year. And in fact, equities are now above the levels that prevailed prior to the pandemic. So that boosted income. We've also seen an improvement in house prices, as ironically, the work from home environment has created demand for property. And as a result, house prices have started to rise. So that's also boosted household wealth. Another big contributor has been low interest rates. So low interest rates undoubtedly also provided a boost to consumer spending. And we believe that that will continue. You will continue to see a situation where consumers will continue to spend. It's going to be a moderate recovery. It's not going to be as robust as exports, but it's going to help keeping the wheels on the bus turning in the South African economy. But there are risks. What are those risks? Right. The first one is that we still got COVID circulating in our economy. As you can see here, I show you COVID-19 new cases in South Africa. We've just been through the worst of the third wave. Our new case numbers are starting to fall, but it's nowhere near the sort of levels where it needs to be for us to go back to a level 1 or a level 2. So we are still dealing with this crisis. Then, of course, all the mayhem of July, the mayhem and the destruction that came with the social unrest and the looting in KwaZulu-Natal and parts of Gauteng have probably extended this third wave more than it normally would. And so that's the situation we are in. The good news is, though, the only way to deal with that threat and the fact that we're probably going to have further waves of COVID-19, which is going to do the following. It's going to result in slower consumer spending followed by recovery, slower consumer spending followed by recovery. So it's going to slow our rate of recovery. It's not going to completely derail it. But the only way to deal with this, the only way to defeat this pandemic is vaccinate everybody. The good news is we are starting to make progress on it. We are actually now appearing on a map of global vaccinations. Now, while we're nowhere near Israel or Canada or United Kingdom in terms of approaching herd immunity, we are now at a point where at least 10% of the population have received one shot of the vaccine, or put it this way, just slightly over 5% of the population has been fully vaccinated. So not in the spot yet, but approaching, but at least gaining momentum. And so this is our key challenge. Vaccinate, vaccinate, vaccinate. That ensures our recovery going forward. So we still have the threat of COVID. What's the other risk? Inflation has crept up. So inflation has increased. It hit a recent peak of over 5% in May. And then interestingly enough, in July, it started to come down again. In June, it started to come down again, dipping a little bit to 4.9%. Now, what's been behind the rise in inflation? Well, it's been all imported inflation. It's not generated locally, it's imported inflation. One of the key sources of inflation has been higher global food prices. All right, so global food prices have started to climb up, and it has been transferred to the local consumer, and we're seeing retail prices for food inflation rising. And that's been a source of inflation. And you can see what's happened to global food prices. Have shot up very sharply. Your overall food index, your cereals, your meat. If you look at oil, it's increased even more dramatically than any of those. So we've got rising global food prices. That is a source of inflation. We've also got oil prices that have returned to, not only returned to pre-COVID levels, but have actually risen above your pre-pandemic levels. So oil has rebounded very strongly, and that's been putting some pressure on prices in South Africa as well. But here's the thing about oil. That's not going to continue. We've probably seen the steepest part of the rise in oil prices. That's probably behind us. And we should see oil prices now starting to gyrate and sort of bottom out at the top and then slowly start to drift lower. And part of the reason for that, of course, is that your OPEC plus nations have increased supply to meet global demand. But here's the thing. We at the moment have an unsynchronized global recovery. And it's got a lot to do with the fact that you have uneven access to vaccines. So your advanced countries, they've got vaccines, they've rolled them out rapidly, they have the administrative, health and logistical capacity to do so, and they have made them free and rolled them out rapidly to their populations. And as they've put COVID behind them, they've been able to open up their economies more normally. Plus, they've been stimulating their economies to an extent that no emerging or developing country ever can, simply because it doesn't have the capacity to do so. It doesn't have the tax base to do so. And so you've had this bounce in demand in most of your advanced countries, but the rest of the world, where a lot of the products that go into the production of the goods and services consumed in places like the US, the EU, a lot of those products are produced and processed in developing countries. And developing countries are still struggling with COVID. Developing countries like South Africa, we're not even over 10% of our population that have been vaccinated. So we are still vulnerable to COVID outbreaks. We are still vulnerable to lockdown. And that disrupts transport networks and supply chains. And so you've got this surge in demand and you've got supply not quite being able to meet it. And that is what is pushing up prices. And that's going to be with us for some time to come. And this is causing inflation the world over, even in advanced countries. The interesting thing is, in June, South Africa's consumer inflation was 4.9%. For the first time ever, US inflation is in fact higher than South African inflation. In June, US inflation was 5.3%. So this is a global problem. So what has helped protect us against the impact of rising global inflation, and particularly on commodities like oil, like food, and also on intermediate goods? What has helped to protect us has essentially been that we have a lot of slack in our system. So it's very difficult for companies to pass cost increases onto consumers without hurting their sales volumes, and so they tend to absorb a bigger portion of that cost. All right, that's the first factor and probably the most important factor. The second factor has been the remarkable recovery in the value of the rand. So the rand has rebounded. What's been behind that? Well, the key factor behind that has been the surge in global commodity prices, the fact that we are running a trade surplus of over 8% of GDP, and the fact that we are running a current account surplus. So we've got real positive flows. We are earning foreign exchange. And of course, and you convert that foreign exchange back to local currency, you have to sell the foreign currency and buy the local currency, and that supported the rand. At the same time, we have also seen rock bottom interest rates in the US have meant that investors looking for a return have been more willing to take risk because they're earning an pittance on putting their money in a low-risk investment in the US or in the Eurozone or in Japan or in the UK. And so you've had an increase in risk appetites, which has also supported the currency. But that will probably change. So this is another risk. The US, as I said, the inflation is over 5% now. They believe it is temporary. They believe as the rest of the world becomes vaccinated, a lot of these supply disruptions will start to ease and prices will recede. And to some extent they are true, they are quite right. But that period of transition can be more than a year. It could be even 2 years in which we will be dealing with higher inflation. And the US Federal Reserve, although they're reluctant to start moving interest rates, have acknowledged that they'll probably have to start normalizing their monetary policy by 2023. But before they can normalize their monetary policy, they have to cut. They have to start cutting their balance sheet. So they have to stop the quantitative easing programs. They have to stop the printing of money. They have to unwind those programs. And what happens the moment they start doing it? This graph shows you the balance sheets of your major advanced countries, the central banks of your major advanced countries, and you can see the amount of money printing that have carried on. Now they've got to reverse that, okay? And what does that mean? It means you're taking dollars out of the system. So the moment you start unwinding quantitative easing or the printing of money, you're taking dollars out of the system. You're mopping it up from all over the place. Then there's less dollars in circulation. The moment there is less of something, it is scarce in relative terms. What happens to the price of something? It goes up. That's when the dollar will strengthen and all other currencies will start to weaken, including the rand. So the outlook for the rand is a little bit more vulnerable. So when will they start tapering their bond purchases? Probably in early 2022, because before they can hike interest rates in 2023, they have to ease and taper their bond purchases. So that's probably going to be early next year. And it is that point where the rand's probably going to be more vulnerable. And the Reserve Bank knows this. And it's because of that they are looking to hike interest rates in November this year, because they expect this is when the rand's going to wobble, and that could be a source of inflation on top of rising global food prices, higher global oil prices, and rising global inflation in general on all intermediate goods. And they're thinking, well, maybe this could become a threat. So they're proposing we hike interest rates 25 basis points in November, another 100 basis points in 2022, and another 100 basis points in 2023. Here's our argument though. Yes, the rand will be more vulnerable towards the end of this year and particularly next year. But it's going to push inflation up a little bit, but not a lot, right? It's not going to have a dramatic impact on inflation. Why? Because we still sit with a massive negative output gap. What does that mean? Even as the economy is recovering, we are so below our potential capacity that we're not putting any pressure on prices. All right? All of that slack in the system is still containing price pressures. It is still making it difficult for producers, for wholesalers, for merchants, for retailers to pass on cost increases onto the consumer. So instead of inflation running away, it's probably going to be quite contained. And in fact, the Reserve Bank's own forecast suggests that inflation will be quite contained, around 4.5%, which is the midpoint of their target range over the next 3 years. So here's the thing, in a country like South Africa, where we've just had violent riots, where we've lived through a situation where we've had severe lockdown, where employment has been exceptionally slow to recover, where absolute poverty levels have increased absolutely. Under those circumstances, is it really such a smart idea to start hiking this year? We don't think so. We don't think the growth story or the inflation story is going to give them enough ammunition to hike rates. Next year, however, will be a different story. That is when you probably will see interest rates start going up. Will it go up by 100 basis points like they're anticipating and another 100 basis points in 2023? We don't think so. We think it's probably only going to be about 100 basis points, which is 1% higher from where we are now. Okay, so all of that means that we have got risk. Inflation is edging higher. There's upside risk to inflation. Most of it is coming from global sources. The outlook for global inflation is uncertain. It may take 2 or 3 years before some of these supply blockages are cleared and resolved. And then at the same time, of course, we're still dealing with COVID. So those are the downside risks. But if interest rates only go up by the extent that we anticipate, then it shouldn't stop the recovery. So what are we saying overall? We are saying at the end of the day, you're still going to have strong export growth and you're going to have consumer spending growth. It will slow from next year onwards as interest rates start to rise, but it isn't going to turn negative or be a drag on this economy. So consumer spending and exports will keep the wheels on the bus turning. Fixed investment will be slow to recover, and government spending is in fact going to be a drag on this economy going forward. What does that produce in totality? It brings us to a situation where we've got 4.2% growth in GDP this year, about 2% next year. As interest rates start to go up, some of the air comes out of consumer spending, it slows a little bit. 1.6% in 2023 and 0.7% in 2024. Now, we could do better in 2023 and 2024 than we're saying, but what is the key here? The key is we need to resolve the energy crisis. And if companies take up the concession of 100 megawatts of embedded generation, and they start putting in place their own generating capacity, and that frees them from the electricity constraint, and as demand recovers, they start to exploit opportunities more, then fixed investment might be more robust by the time we get to 23-24. If fixed investment is more robust, employment will be more robust. More people will earn an income. More people will have the ability to spend. And as a result, our GDP numbers for 2023-24 could perhaps be too pessimistic. So there is that potential upside. But the key is really that we need to resolve some of these key blockages to the economy. And it starts with state-owned enterprises and it ends with state-owned enterprises. And if we can deal with that crisis and we can find ways around some of these infrastructure constraints, perhaps South Africa has a better shot at producing stronger growth and creating some jobs, and in the process, buy ourselves some social stability in the years ahead. Thank you very much.